Right now, as I am recording this, silver is trading at $82 on COMEX in New York. Pull up the Shanghai Gold Exchange at the same moment. The price there, converted to US dollars, is $13 higher, not $1 higher, not $2 higher, $13 on the same metal at the same time. And here's the part that should stop you cold. That gap is not closing, it is growing. Meanwhile, on first notice day for the March contract, delivery notices were issued for 10,126 contracts representing 52.63 million ounces of silver. That demand represents more than 60% of the total registered inventory, leaving a dangerously small margin for error. Light finance, 60% of COMEX's entire registered supply, claimed in a single day. So the question I am going to answer today is not whether silver will go up or down. The question is where the physical metal is actually going, because New York says one price. Shanghai says another, and the delivery data says the metal is leaving. Let me build the full picture from the ground up. Every number I give you today is public and verifiable. Links to all sources are in the description. Section 1, 2 markets, 1 metal, completely different prices. Let me be precise about what is happening here because the financial media is almost entirely ignoring this story. There are 2 major global silver pricing systems. New York's COMEX, which is a futures market where the vast majority of contracts are settled in cash rather than metal, and the Shanghai Gold Exchange, where physical delivery plays a far more central role. In the US and Europe, silver prices are largely determined on markets like COMEX and in London, where futures contracts and financial instruments dominate trading activity. The vast majority of these contracts are settled financially rather than through physical delivery. As a result, prices tend to reflect liquidity conditions, speculative positioning, movements in the US dollar, and interest rate expectations more than the immediate availability of physical silver. Investing live. Shanghai works differently. On the Shanghai Gold Exchange and the Shanghai Futures Exchange, physical delivery plays a far more important role. Prices in Shanghai are therefore much more closely tied to actual demand for metal that can be taken out of the exchange system. Investing live. That distinction matters enormously right now because the current situation, around $94 per ounce in the US versus about $104 per ounce in Shanghai, suggests that physical silver is relatively scarcer and more highly valued in China than in Western markets, and that Western paper prices may not fully reflect physical market tightness. Investing live. At today's $82 COMEX price, that same $10 to $13 premium structure means Shanghai is pricing silver at approximately 95 on the same metal, in the same hour. That is not a rounding error. That is 2 completely separate markets pricing the same commodity based on completely different realities. One is pricing a paper promise, the other is pricing a physical bar you can hold in your hand today. Section 2, why the gap won't close. The arbitrage machine is dead. The natural question any economist would ask is this. If Shanghai is $13 higher, why doesn't someone just buy silver in New York, ship it to Shanghai, and pocket the spread? Under normal market conditions, that is exactly what would happen. Arbitrageurs would compress the premium within days. The fact that this gap has been persistent and is now widening tells you something fundamental has broken in the global silver supply chain. Under normal circumstances, arbitrageurs would buy cheaper silver in New York or London and ship it to high-priced markets like Shanghai, compressing the spread. But under the current conditions, tight inventories and export constraints mean the quantity of silver that can actually be moved is very limited, and arbitrage cannot fully do its job. Kitco. There are 2 walls blocking the arbitrage machine. The first is physical. COMEX registered inventory, the silver actually available for delivery, has been draining at historic speed. Registered silver has declined over 70% from its 2021 highs. Finance magnates. When the deliverable pool is shrinking this fast, there is simply not enough metal sitting in New York vaults to buy cheaply and ship east. The second wall is regulatory, and this one is new. China's Ministry of Commerce has officially added silver to the list of dual-use items following the precedent set by gallium and germanium. This means strict licensing where Chinese refiners now require special state permits to export silver bars or granules, a quota system where export volumes have been drastically slashed, with market observers reporting a reduction of up to 40% compared to last year, and price controls where exports below a state-defined minimum price pegged to the Shanghai price are effectively banned. Intellectia.ai. Read that carefully. China has built a one-way valve. Metal can flow in, it cannot flow out. The implementation of strict export controls on refined silver by China on January 1, 2026 has severed traditional arbitrage routes. This has led to a persistent premium of $8 to $13 per ounce on the Shanghai Gold Exchange compared to Western prices. Light finance. New York to Shanghai works. Shanghai to New York is broken. And as long as that regulatory wall stands, the premium does not close. It widens. Section 3. The vault picture right now. Where is the metal going? Let me give you the exact trajectory of COMEX registered silver so you can see the drain with your own eyes. Shanghai inventory collapsed from 559 tons in November 2025 to 318.5 tons in February 2026. That is a 43% decline in 3 months. One India. At the same time, COMEX registered silver has been in freefall. During the first week of January alone, COMEX warehouses experienced a 33.45 million ounce withdrawal in just 7 days, representing 26% of registered inventory vanishing in a single week. Light finance, 26% gone in 7 days. Combined COMEX and Shanghai drawdown over 6 years represents approximately 161 million ounces, which is 19.6% of the 820 million ounce cumulative deficit. One India. Now here's the data point that should make every person watching this sit up straight. The coverage ratio, which measures what percentage of outstanding paper claims could be satisfied with registered inventory, currently stands at 15.4%. Below 15% is considered stress territory, historically rare and associated with delivery squeezes. Paper leverage is elevated at 6.5 times, meaning significantly more paper claims exist than deliverable metal. Fortune 6.5 paper claims for every single deliverable ounce at 15.4% coverage. That is the math behind the $82 price you see on your screen right now. And there is one more number that explains exactly where the metal is going. January 7th, data revealed JP Morgan issuing 99% of 8.1 million ounces in delivery notices through 1,624 contracts. What made this unusual was that January open interest increased by 1,431 contracts despite these deliveries. Light finance. JP Morgan was not just taking delivery. New participants were entering to demand delivery at the same time. The queue was not clearing. It was growing. Section 4, the lease rate signal that Wall Street is not talking about. There is a number most retail investors have never heard of that is screaming louder than any price chart right now. Silver lease rates. Here is how lease rates work. When institutions or central banks that hold physical silver want to earn a yield on it, they lend it to market participants who need metal. The interest rate on that loan is the lease rate. In a normal, healthy silver market with adequate supply, 1-month silver lease rates typically sit around 0.3% to 0.5%. U.S. Bureau of Labor Statistics, that is the baseline, 0.3 to 0.5%. The price of borrowing silver when supply is comfortable. By January 2026, this rate had exploded to around 8%. U.S. Bureau of Labor Statistics. From 0.5% to 8%, that is a 16-fold increase. And the message it sends is brutally simple. When someone is willing to pay 8% annualized just to borrow silver so they can be sure to take delivery on time, that in itself is a signal. Physical supply and demand are severely out of balance. U.S. Bureau of Labor Statistics. But it goes even further than lease rates. The entire futures curve has flipped. Silver's current $2.88 backwardation, the largest since the 1980s, is sending a clear message to the market. Buyers want real metal now, not paper promises for later. Investing.com. In normal markets, futures prices are higher than spot prices because of storage and insurance costs. When that relationship inverts, when you pay more for silver today than for silver delivered 6 months from now, the market is telling you one thing: do not trust the future promise. Get the metal now or pay a premium. Every contract through late 2026 is trading below the current spot price. That tells us this current backwardation is not just a short-term quirk. It is stretched across the entire curve, which means the market expects physical scarcity to last for years, not months. Investing.com. Backwardation across the entire 2026 futures curve. 8% lease rates, 15.4% coverage ratio, $13 Shanghai premium. These are not 4 separate data points. They are 4 different instruments all playing the same note at the same time. Physical silver is genuinely scarce. Section 5. What China's export wall actually means long-term. I want to spend a moment on China's January 1st policy because most of the coverage has focused on the short-term price impact without understanding the structural shift underneath it. Physical silver in Shanghai is already trading at a premium of over 12% compared to the theoretical spot price in London. Anyone wanting actual silver must pay the China price, not the paper price. Intellectia.ai. But here's what that means for the global market beyond just a premium number. China consumes approximately 20% of global silver production annually for industrial use alone. Solar panels, electronics, electric vehicles, semiconductors. When China restricts exports, it is not just keeping its silver at home. It is removing the buffer that Western markets depended on to meet delivery obligations. COMEX registered inventories in the United States are down nearly 70% since 2020. London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. FX Street 30 to 45 days of accessible reserves. For the industries that literally cannot function without silver, solar panels cannot be manufactured without silver paste. Advanced chips cannot be produced without silver bonding wire. And right now, the regions that make those products have a month of supply sitting on their shelves. The solar industry in Europe and the USA is under particular pressure. China controls a vast portion of refining capacities. Without refined silver from China, the production of photovoltaic modules and high-performance chips is stalling. Initial reports suggest that major tech corporations are now attempting to buy directly at the SGE and import the metal via circuitous routes at exorbitant costs. Intellectia.ai circuitous routes. At exorbitant costs. That is not a market in equilibrium. That is a market in active stress, trying to work around a wall that was not there 6 months ago. Section 6. The ETF problem. Nobody is discussing. There is one more layer to this paper versus physical story that I want to address, specifically because it affects millions of retail investors directly. Most people who think they own silver through ETFs believe they have exposure to physical metal. The reality is more complicated. Most silver ETFs do not operate like simple vaults holding unencumbered metal for shareholders. They rely on a complex structure involving authorized participants, custodians, sub-custodians, leasing arrangements, and unallocated metal. Under normal conditions, this system functions smoothly. Under physical stress, it does not. FX Street here is what that means in plain terms. When physical silver becomes scarce and lease rates rise, authorized participants may be unwilling or unable to source metal for ETF creation or redemption. In such scenarios, ETFs can begin trading at persistent discounts or premiums to net asset value, suspend redemptions, or be forced into cash settlement. Investors believe they own silver, but in reality hold a paper claim with growing counterparty risk. FX Street. This is not a fringe concern. In 2021, the LBMA overstated its silver holdings by some 3,300 tons. Although this was later explained away as a calculation error, it left a deep scar on market confidence. U.S. Bureau of Labor Statistics a 3,300-ton accounting error at the world's most important precious metals trading hub, filed under calculation error. The difference between holding allocated physical silver in your name and holding an ETF share is not a trivial distinction right now. It is the difference between owning metal and owning a promise that the metal exists. In a market where lease rates are at 8% and registered inventory is at 15.4% coverage, that distinction is no longer theoretical. Section 7. The bear case. Why the gap might not matter. I always give you the honest counter-argument because analysis without the other side is just a sales pitch. The strongest bear case on the paper versus physical divergence is this. COMEX has never formally defaulted on a silver delivery obligation. Every time delivery stress has appeared in the past, the exchange deployed its tools. Margin hikes, exchange for physical arrangements, rule modifications, cash settlement clauses. The bears argue that these tools will work again in 2026 as they always have. The elevated lease rates indicate that metal exists but faces temporary obstacles to immediate delivery. According to LBMA research, this reflects wrong location, wrong form, or metal tied up in uses that prevent immediate lending rather than fundamental shortage. The market has weathered similar tightness episodes before and rebalanced. FX Empire. That is a credible argument. Metal in the wrong location is not the same as no metal, and COMEX's institutional tools are real and have worked before. The bear case also points out that a $13 Shanghai premium, while significant, is not unprecedented in isolated episodes. Historical supply disruptions have produced temporary regional premiums that eventually closed when logistics normalized. Here's why I think the bear case is incomplete but not wrong. It assumes this cycle behaves like previous cycles. The previous cycles did not feature China simultaneously restricting exports. COMEX registered inventory at 70% below 2021 highs, lease rates at 8%, backwardation across the entire futures curve, and a structural deficit running for 6 consecutive years. Any one of those factors alone would be a yellow flag. All 5 running simultaneously is a different category of event. The tools that worked when one pipe was clogged may not work when the entire plumbing system is running at minimum pressure simultaneously. Section 8. The 3 market picture: New York, London, Shanghai. Let me give you the complete picture of how all 3 major markets are pricing silver right now, because it tells the story more clearly than any single number. 3 markets are telling 3 different stories. COMEX paper says, everything is fine, just normal commodity trading. London Physical says we need metal now and we'll pay up for it. Shanghai Physical says we will pay $10 to $15 premiums over COMEX because paper prices are fiction. Yahoo Finance New York, paper dominant, 6.5 paper claims per deliverable ounce. Futures price, $80. London, Physical stress, lease rates at 8%. Backwardation at 2.88, the largest since 1980. LBMA free float near historic lows. Shanghai, physical delivery focus. $13 premium over New York. Export wall blocking arbitrage. Industrial buyers paying whatever it takes to secure supply. When physical markets diverge from paper markets like this, history is clear. Paper eventually reprices to physical reality, not the other way around. Yahoo Finance. That sentence is the thesis of this entire video in one line. Paper does not set the price permanently when physical markets disagree. Physical markets eventually win. The question is not if. The question is when and how violently. Section 9. What to watch. Free and public data. I sell nothing. No memberships, no paid alerts, no Discord. If you see my name on any paid service that is not this channel, that is not me. Here is your complete watch list. Every item is free and publicly available. Shanghai Gold Exchange Premium Tracker. Updated daily. The number to watch is the spread between SGE AGI T plus D and COMEX spot, converted to USD per ounce using the daily CNY USD rate. If this premium widens past $15 while COMEX registers below 80 million ounces, that is the most significant physical stress signal available in real time. Link in the description. COMEX Daily Silver Inventory Report from CME Group. Watch the registered category specifically, not total inventory. Total inventory includes eligible silver that owners are not making available for delivery. Only registered matters for delivery math. A drop below 70 million ounces in the next 30 days would represent historically significant physical stress. Link in the description. Silver lease rates published by the London Bullion Market Association. Updated daily. The current 8% level is already at crisis territory. Watch for movement toward 10% or above, which would signal that the market is struggling to source lendable metal even at extreme cost. Link in the description. COMEX futures curve structure. Available on CME Group's website. Watch for deepening backwardation. If the front month trades more than $3 above the 6-month forward contract, the market is pricing an acute near-term delivery crunch. Link in the description. CME Daily Delivery Reports, published each afternoon, shows exactly which institutions are issuing and stopping delivery notices, contract by contract. This is the most granular, real-time signal of who is demanding physical metal and who is rolling their paper. Link in the description. EFP spread data. The exchange for physical spread measures the price difference between COMEX futures and London spot. When this spread spikes, it means institutions are paying a premium to move delivery obligations from New York to London. A rising EFP confirms the managed roll scenario is actively happening to defer physical stress. Link in the description. Section 10. The honest conclusion. Here's the complete picture as of today, March 6th, 2026. COMEX silver spot price, approximately $82 per ounce. Shanghai Gold Exchange silver price, same metal, same moment, approximately $95 per ounce. A $13 premium that the arbitrage machine cannot close because China's export wall blocks the flow. COMEX registered silver inventory, approximately 86 million ounces, down 70% from 2021 highs. Coverage ratio at 15.4% inside historical stress territory. March delivery demand on first notice day, 52.63 million ounces, representing 61% of total registered inventory claimed in a single session. Silver lease rates, 8% per annum, up from a historical normal of 0.3 to 0.5%, a 16-fold increase signaling acute physical scarcity. Futures curve backwardation, 288, the largest since 1980. Every contract through late 2026 trades below current spot. The market is pricing physical scarcity for years, not months. China export controls, fully operational since January 1st, 2026. Export volumes reduced up to 40% from prior year. Arbitrage route from New York to Shanghai, open. Arbitrage route from Shanghai to New York, blocked. ETF counterparty risk, elevated. Structure depends on authorized participants sourcing physical metal at 8% lease rates during a delivery crunch. The paper price at $82 and the physical price at $95 represent two different markets pricing two different things. One is pricing a financial instrument, the other is pricing a bar of silver you can take delivery of today. In every historical episode where paper and physical markets have diverged at this scale, the outcome has been the same. Paper reprices toward physical, not the other way around. The question is not whether silver at $82 reflects reality. The question is what reality the $82 is reflecting, and whether that reality can persist as delivery demands hit 61% of registered inventory, lease rates sit at 8%, and Shanghai continues paying $13 more than New York. I am not here to tell you what to buy. I am here to show you the math and let you decide what it means. Pull the CME inventory report this afternoon. Check the Shanghai premium tomorrow morning. Watch the lease rates this week. The data will tell the story. Your job is to look at it. Invest with logic, not hype. Protect your capital. And understand the difference between the price on your screen and the price of metal in your hand. Right now, those two numbers are $13 apart and the gap is growing. Drop physical or paper in the comments if you actually pulled the Shanghai premium data today.